Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, March 13th, 4:54 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in a correction complicated by a pseudo bank panic over the last week as the government seized two institutions, and there was a bank run. There was massive gaps down on several community banks, regional banks. But over the weekend, the government took some steps to at least make sure that the customers were taken care of. The shareholders of these institutions, that's a different story. But that's what capitalism's all about. Shareholders don't get bailed out. You just hope that um, Main Street ends up unscathed when you have situations like this. So let's check our trend gauge. We track 5 indexes across 3 time frames and also leading stocks. Leading stocks are neutral, leaning, bearish. Still have 21 easily that are holding up okay. Short term, all 5 of the major indexes are below their 21-day moving average. Medium term, all below their 50-day moving average. Actually, I think the NASDAQ 100 might have undercut and reclaimed. We'll check that. Long term, 4 of the 5 below their 200-day moving average. NASDAQ also, I believe, undercut and reclaimed. Weird for the NASDAQ to be in the flight to safety category, but that's where those big tech companies found themselves the last couple of days. So what happened today? As I said, government calmed the markets. Major support on the S&P 500 held. That's the 3,800 level. We've got CPI in the morning, so inflation data coming in. We've got the additional crosswind of CPI and whether or not good news is bad news, because this bank fiasco added into the mix is a wild card that I think the markets are still sorting out. So here are the numbers on the day. G6 down 0.34%, S&P 500 gap down 1.05% at the open. Put in the low pretty quickly, right near that 3,800 area, rallied up to 3,900 resistance, pulled back and closed about midway between them, ended up down 0.15% on the day. I would consider that a win for the bulls. NASDAQ 100, as I said, flight to quality there, up 0.74%. Dow down 0.28%. Mid caps and small caps rife with financials continue to lag, down 1.9% on mid caps, down 1.6% on the Russell. Global diversified 60/40 stock and bond up 0.27% on the day as money flowed into bonds, meaning rates down, but they did have an intraday reversal. Rates bouncing off of their lows and prices bouncing off of their highs, significantly off of the panic highs at the open. GROTECTION in-house, we were up 0.08%, worked through getting rid of our hedges and directional SSO plays and just holding 4 remaining names. We'll see what CPI brings tomorrow, but more importantly, we need to get back above the 200-day moving average. And of course, above the medium-term, short-term moving averages as well. So let's dive right into it. We'll start off with a chart of the S&P 500. And why do we do what we do at Revere? It's to keep our clients out of the way of these severe bear markets. They all take place under the 200-day moving average, where we found ourselves rescued from most of the year this year until last Thursday, when the bank panic started. Break of the 200, 2 more days down. After that, this is when we really get defensive, because history shows all of these bear markets occur under their 200-day moving average. In fact, we bounced that 3,800 level. That's 20% off of the prior high. So we went as low as 27.5% off of the high last October, bounced up on the way back down now. We're right at 20% off the highs, maybe about 19% now, actually. So protection when it's called for, aggression when it's proper. That's what we do here at Revere. So here's the S&P 500. You can see the 3 closes now below the 200-day moving average, wide range each of the last 3 days. We were trading tight in about a 1.45% range. The last 3 days, over 2% on the range. You can see the S&P 500 tried to move off of oversold. We look like we had bonds and the dollar cooperating until this bank fiasco reared its head, primarily last Thursday. So discretion, the better part of valor in a market like this. NASDAQ 100, the leader, continues 2 weeks of relative strength. Undercut reclaimed the 50-day and the 200-day, still below the 21-day, but definitely the leading index right now. Note the high of the day very near the declining 21-day moving average, which is very typical. When you're bearish, you attempt to rally up. That's usually the first significant level that you run into and fail. Look at all of these attempts to get back above it here in late February. 1, 2, 3, 4, 5 before we finally poked above it. Had a nice little 3-day rally and gave it up. Gave normal 2-day pullback after that before Thursday kicked in. So there's your NASDAQ 100 outperforming as market flowing to the safety of companies like Apple, Amazon, Google, Microsoft, Meta. Note the attempted hookup off of oversold in NASDAQ 100. This is definitely the healthiest of the 5 major indexes. Let's go to the Dow. Lower lows on the close again, 3 closes below the 200-day moving average in oversold territory. MDY begins the carnage of these 3 big days down. Second close below the 200-day, actually right on the 200-day, a tenth of a percent below. That's basically a rounding error. Getting very oversold. You see the slope of the line going lower, approaching 0. That's extremely oversold. I would expect a snapback rally in these banks, mid caps, and small caps. The rubber band can only stretch so far. Same situation here on small caps. Second close under the 200-day moving average, just a mess here. When it comes to banks, here's the regional bank index down another 12% today. So this has dropped from 60 down to 44. 25% move down in 3 days. Amazing. KBE has a little bit more of a weighting toward some of the more money center banks, not down quite as bad, but still down 10% today. XLF, very quickly, we'll check. Financial sector also down 4% on the day. So let's go to, first of all, the dollar. Weaker dollar, normally a help to stocks. 3 days down on the dollar, but 3 days down on the market also, as we're overlooking the weakness in the dollar in favor of the flight to the return of your money instead of return on your money. Big support level here for the dollar around this 28 area. You can see where we gapped up here and all pullbacks had held it. That's right at the 50-day moving average after the 200-day moving average held as resistance. You can see heading basically straight down here off of overbought. This is normally a tailwind for stocks. And again, if this panic subsides and the fear leaves the market and we get a possible CPI report, we are kind of set up for a move higher. The question of the move higher, we'll review it when we get into a little bit more of a breakdown when we go to the tail of the tape. Let's go to the VIX. Continued higher for the 3rd day, but well off of its highs, up 8% above this 25 level. But again, rubber band stretched. It was up near 31 at the high of the day, closed well off the high, very similar to how it closed well off the high on Friday. Bonds now. Let's start with The broad bond index BND up 0.8%. Price up means yield down. Now TLT was the big move here. Big gap up. Let's go to a 5-minute chart on this. Big gap up on TLT, topped early along with stocks and then just trickling lower throughout the rest of the day. So big move up. Let's go to a 15-minute chart here. It's pretty obvious. So here, Friday was the first gap up, the second gap up. Today, basically, we are right around where we were at Friday's close, only up 0.23% on the day, and that means that yields plunged, but then rallied. You can see that gap down, about where we were at the close on Friday also there. So just like on the daily chart, we put in an island top. I would not at all be surprised if this was the shakeout bottom at the 200-day moving average, this 3.5 level, very similar to where we bottomed here at the beginning of February. So again, if we can get price, the yields to come off or stay lower, hang out down here, that would benefit stocks also. But again, we need to get that fear issue out of the market. Junk bonds down on the day, which means rates higher. That's pretty much in line, but not a major fear anyway here on junk bonds. I know the spread is widening between quality corporates and junk bonds. LQD, you can see here up on the day, but well off of the highs also. So early in the day, bond yields plunged as the prices popped, and then we just saw the opposite action intraday that we saw with the market. TNX, the 10-year, also a big gap down, but closed near the high of its range, also bouncing at the 200-day moving average. Flight to safety, gold, yep, it was today. Excuse me, for the second straight day, up 2.3%, well above its 21. Interesting action in gold here where we have been selling off for a while. We had a 4 out of 5 day rally, gave it all back up, and now up 3 days. So definitely acting, and note relative strength at a high before price in gold also. That's bullish. That was up 2%, but up much more than that were gold stocks, up 7% on the day, regaining their 21-day moving average after 1, 2, 3, 4, 5 weeks below it, still below the 50-day moving average. I'm going to set an alert right there at that 30 level for GDX. Silver, SLV, up 6% on the day, also reclaiming its 21-day. Now the big weird thing on the day was the massive strength in crypto, particularly Bitcoin, up 22% on the day. So apparently some people are convinced that Bitcoin is safer than fiat currency, and those people are doing a victorious dance right now. They've been saying it basically forever. They're going to ignore the fact that we're 70% off the highs in Bitcoin, but hey, Bitcoin did today what one of its, let's say, its base use cases is, which is a safe store of money in turbulent market times and or fiat currency times. I'll let you be the ultimate judge on that, but I mean, to me, like I said, there's 8,000 cryptos, and about 5 of them are worthwhile, if that, and that probably includes the stable coins too. So those are the major indexes that we check. Let's go to the tail of the tape. You can pause here to read through it. I'll hit a couple highlights. So the government bailed out the customers, created this BTFP loan, short-term loan. So basically what happened with SIVB is that they had a duration mismatch. They had a bunch of money in long-term bonds whose value plunged because short-term rates went substantially higher. So the government, if you have treasuries or quality mortgage-backed securities, you can pledge those as collateral to get the short-term loan to stem any flow, any liquidity, short-term liquidity issues. So they saved the customers. They created a way for the banks to get the liquidity that they need. One of the questions was, I read it was 25 billion. Is that enough? Because there's over 600 billion in loans that are underwater because of the quickly rising interest rates. Again, it's not an issue unless liquidity becomes an issue, but the banks apparently have the short-term liquidity that they need right now. Not that there aren't plenty other of headwinds to the market. Does this guarantee that we're going to have a recession now? Are banks going to stop lending to people? Um, are the credit markets going to tighten up? That's going to cause more layoffs, and that may be causing the recession that people have been long predicting. I don't know for certain, but we know that it usually shows up on the charts because, as Stan Weinstein says, the tape tells all. So the day count from down 2 to down 1 with a consolidation, 5 days under the 80 EMA and the 21 EMA, and we're stretched to the downside on both of them. Rate hike chances now. This is big. We were leaning just the middle of last week to over 80% chance of a 50 basis point hike at the Fed meeting next Wednesday. Now we're down to 58% of zero hike and 42% of only a quarter point hike. Big change over the last week. We'll see how this plays out leading into the Fed. And then, as I mentioned, CPI tomorrow morning. Normally, this would be the only thing that we're focused on, but it's almost pretty much taken a back seat to what's going on with the banks. So we're still negative expectations since we're under the 200-day moving average. We bottomed early, range chop after that. Here are the sectors. Here's what we're still holding. We got rid of SPXS and SSO, basically selling SPXS on weakness, using the stochastic, and getting rid of SSO since we're under the 200-day moving average on intraday strength. The bottom line is that our portfolio risk 0.04 coming into today with the bounce off of 3,800, which is a big support area. We're up to 0.17% or 17% risk versus the S&P 500. Bottom line, government calm the markets. 3,800 support holds. CPI in the morning. Why is 3,800 so key? It was a big area, even back in from mid-December to the first week in January. This is the 20% year-to-date area. It was also a big area before we had that final third leg down, and it's a big fib area versus the COVID low to high. The next level down is quite a way down. That's the 3,500-ish area where we bottomed on 10.3. That's the 50% retrace of the COVID rally. We certainly don't want to go down another 350 points or 10% to that area. So this 3,800 is very key. On the upside, where we got stopped today, 3,900. That's big May, June, July, September support and resistance area. Let's go back to the S&P. And this is really what we're talking about here. This area in here, December and January, that's where we came down. That's where we held. This is where that base formed that we had this most recent run off of the bottom. And looking back here, this was a big area back here. It also played a role back here in October. So the markets have a memory. When you extend this horizontal line going back and you see how many times this area was touched and bounced and either provided support or resistance, and it's also 3,800 is a reasonable area for the forward PE depending on what earnings. Earnings are looking to be around 210 bucks going forward. So basically a reasonable PE going forward makes 3,800 a quote unquote value area. So it seems as of right, it's, in other words, to me, if we break 3,800, it's a problem. That's the bottom line on that. So today's lows need to hold. Let's take a look at a couple of charts. We'll basically just look at the 4 that we are still owning in-house, nothing else. Well, maybe one stood out to me today, but everything else just really hanging around where it needs to, no major strength. So Transmedics, TMDX, story stock, we still have a 1% position in this, undercut the 21-day, held the bottom of the gap up day. That's always an important level. And we definitely want to, we got stopped out on our post gap up ads on this stock, but we're still holding the lower cost shares that we have from back in January. And then the 3 leaders that we still own, 2% size on each. Arista, great action today. Palo Alto, PANW, also good action today. These are holding their 21. Not such good action, but it's still a normal pullback for First Solar into its 8 EMA. And those are the 3 that we own. Other 2 that we've got a close eye on. We got stopped on Nvidia at undercut and reclaim the 21-day today. And I also like the action in 4 FOUR as it's holding the 21 on this pullback after serious buying on this gap up on its earnings after unfairly being thrown in with toast on this gap down on 216. So that certainly is one of my top 6. That's going to wrap it. As always, love to hear from you. The email is don@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the markets, it's how much of that you can keep. That's why we protect capital, particularly when the major indexes are under the 200-day moving average. And with that, I'll wrap up Monday, March 13th. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.